The highly anticipated non-farm payroll report was published on Friday and showed that the US economy added 263,000 jobs in September 2022, which came slightly above market forecasts of 250,000 and a touch below the revised 315,000 print the prior month. This is the lowest reading since April 2021 and shows that the current interest rate hiking cycle and higher prices have started to impact the economy. The US unemployment rate fell to 3.5%, coming in below market expectations, and the August print of 3.7%, showing that the labor market remains tight, which could give room to the Fed to stick to its interest rate hike projections. The yearly average hourly earnings decreased to 5% from 5.2% in August and are well behind the annual rate of inflation. On a monthly basis, the average hourly earnings came at 0.3%, remaining unchanged from August. Clearly, the US economy is proving far more resilient in the face of sustained pricing pressures. The solid job gains in September, the 3.5% unemployment rate month on month, and the average hourly earnings increase of 5% year on year are probably not sufficient for the Fed to pull back from its efforts to restore price stability. Despite a slowing in the pace of hiring and significant decline in job openings, it is still likely the Federal Reserve would increase the federal funds policy rate by 75 basis points in November, bringing the official cash rate to a range between 3.75% and 4%. Perhaps the Federal Reserve would need to observe a series of monthly job reports with a top-line change in total employment of around 100,000 per month to consider a pivot. The minutes of the latest Fed meetings is on Wednesday and could provide some insights into how Fed officials view the economy and the inflation outlook. The September's CPI data, scheduled to be released on Thursday, 13th of October 2022, is keenly awaited by market participants and should provide more clues whether the Fed is likely to extend its aggressive rate hike campaign. Another elevated inflation reading on Thursday should support the case for further hawkishness from the Fed. Oil prices are in the spotlight after OPEC Plus' decision to cut oil production by 2 million barrels per day, despite the pressure from the US to keep global oil prices down. Overall, given the current fundamental backdrop, equity markets are likely to remain under pressure in the coming months. Thank you very much for watching. See you next time.